Let's get a check now of the top business news stories. I'm joined by our business editor, Kate Moody. Hi there, Kate.
Hi, Tom.
It seems there's been more progress in this saga with regards to Facebook and Australia and who's paying for news content. And it seems that it could be Facebook that's actually going to be paying for that news content.
Yeah, it's certainly taking steps towards it just a day after it agreed to unblock that news content for Australian users. Facebook claims to have spent $600 million on the news industry in recent years and has today pledged to match Google's billion-dollar budget for news content going forward. Last week, the social media giant blocked news stories in Australia in protest over a draft law which would force online giants to pay publishers whose work is featured on their platforms. Google, while also pushing back at that legislation, has itself been brokering deals with media outlets in Australia in particular. In a blog post on Wednesday, Facebook said it was in active negotiations with news companies in both France and Germany, but it defended its own move in Australia, saying again that it was the result of a fundamental misunderstanding of the relationship it has with news publishers. The Post likened Australia's push to forcing car makers to fund radio stations because people might listen to them in the car and then letting stations set the price. And it went on to accuse publishers of a degree of hypocrisy by appearing to be in favor of state-sponsored price setting. Let's check in on the day's trading action now. The major European indices closed higher. The DAX outperformed. It was up 0.8 of a percentage point after data confirmed the German economy had expanded a stronger than expected 0.3% in the final quarter of last year. Shares of the French hotel group Accor rose nearly 3%, despite reporting net losses of almost €2 billion last year. Wall Street is trending higher. Boeing shares have jumped 7%. That's pushed up the Dow Jones 1.5% there. That as the aviation giant recovers from the engine failure of one of its Boeing 777 planes this weekend. Shares of Johnson & Johnson are up 2% after U.S. regulators took a step towards approving its COVID-19 vaccine for distribution. U.S. President Joe Biden is set to sign an executive order which will launch a review of a number of industries in which he thinks the U.S. may be too dependent on other countries. Among them, semiconductors, the majority of which are currently produced in Asia, large-capacity batteries like those used in electric vehicles, pharmaceuticals, drug ingredients, and medical supplies, and as well as rare earth and minerals. Now, the review will determine the risks in each area and push American companies, if needed, to try and relocate their suppliers either to the U.S. or to countries which are seen as closer allies. The text is not expected to specifically name China, but its dominance in many of those areas is clearly being targeted. London's Heathrow Airport lost more than €2 billion last year as the pandemic pushed passenger numbers to their lowest level since the 1970s. The number of people using the airport fell by 73% in 2020. Heathrow's CEO was optimistic about the prospect of a recovery for 2021, saying that Britain was on the cusp of becoming the first country in the world to safely resume international travel. Well, the pandemic has hit the fortunes of trains, planes, and automobiles. France's national rail service, the SNCF, says it lost €3 billion last year, and it says ongoing restrictions could hamper its recovery this year. Mario Sofos reports.
A practically empty train heading to Dunkirk. Ticket sales for the school holiday period are down by 40% compared to the same time last year. France's national rail company SNCF is operating a reduced timetable, with only 3 out of 4 of its high-speed TGV trains running.
I was taking the train before and there were a lot of people, but now there are far fewer. I think people are being more careful. Perhaps they're moving around less.
I usually take the earlier train, and so it's busier. Today I'm taking a later train, the 2103, and there are very few people. I'm a bit surprised.
Deserted trains and empty stations. It's less than a year since France's first lockdown, when at their lowest level of service, TGV trains were carrying 1% their normal level of passengers. 3,500 trains were running per day compared to the usual 15,000. In summer, following the lockdown, train stations resumed service and travellers streamed in. A breath of fresh air for SNCF after coming to a relative standstill. Then in autumn, a second lockdown was imposed, adding to an already gloomy outlook for the rail company. In total in 2020, the number of passengers fell by 42%. For SNCF, it's unprecedented.
SNCF needs to prepare for resumed service and renewed demands, at least for holiday travellers. To do this, it needs to support its drivers and support its staff, even if it costs money today, because the trains are empty. In the mid-term, it needs to shift its focus to holiday travel.
While SNCF has received massive support from the French government, in 2020 the company had a net loss of €3 billion.
And SNCF saying on the back of those pretty staggering losses from last year that they are expecting more cuts in their budget for the year to come.
Yeah, definitely a very tough time for the transport sector. Thank you very much indeed, our business editor, Kate Moose.